200 points higher. That is the kind of gap up open we could see, and it is about 165. 160 points for Nifty, 500 points plus for the Sensex, and it is going to be a new record high. I like that, don't we? New highs, good market breadth, the bulls taking charge. Well, thank you, Fed. That's what I can say. They've given the world a Christmas gift very, very early. 2 weeks ahead, the Santa has come on Wall Street. And for Dalal Street, well, the bull on Dalal Street, which in a sense came out of the cage just before Diwali, has decided just to stay there. What a beautiful looking screen. 1:16 advanced decline ratio, just a sea of green, whichever way you look at it. Now let's start looking at stocks. Now, is it comeback in high growth? Is it comeback in IT, or is it the usual, which is banks, capital goods, and real estate? If interest rates globally come down, obviously it will have an impact on the Nifty, it will have an impact on real estate, it will have an impact on IT. So let's look at IT. TCS, Infosys, Wipro in one breath. TCS, Infosys, Wipro. TCS up 51. IT is actually surprisingly leading the charge. Infosys up 22 rupees, Wipro up about 2%, and then you've got the other one, which is HCL Tech, that's giving it company. Now, what about banks? HDFC Bank, ICICI Bank, are they also coming back, and are they also coming back with some force? Let's look at HDFC Bank, 22 rupees higher there. ICICI Bank, 16 rupees higher. And then you got Uptick, which is there in Axis Bank. I will not be surprised that if the party which is there in some of these stocks, it actually just extend itself for some more. So it's all I can say is that look forward. Where is it? Touch wood.
Yeah, absolutely. It's a picture perfect market there. Let's see what the rate sensitives first are up to. Real estate, banks, are they the ones which are leading the rally for the index today? If we can just bring up Nifty Realty holding up 1.5%, Nifty Bank higher by 1.5%, so that's clearly beating the index, which also is at a record high. And I think these could be all sentimental moves from the Fed takeaways. The fact that they are hinting at beginning to ease, and 3 rate cuts, pretty categoric at that, come next year. So that will also turn all focus on what the RBI as well does. But a lot of other stocks which are in focus, and there's Vedanta. The board is going to be consider a fundraising on December 18th. NBCC, which has got a sizable 1,500 crore rupee order as well. Uno Minda, wherein one of their arms has commissioned a new automotive seating system plant in Ahmedabad. Look out for that too. There's Biocon in focus after a big move on the stock yesterday. One of their associate companies has completed a $165 million Series C financing, so look out for that stock too. There's Escorts, wherein the chief officer for the agri machinery business as well has handed over his resignation. It seems like a season for his resignations, really. But there's IRCTC also, which is looking to diversify into non-railway business catering too. So look out for that. Honasa Consumer, when JP Morgan has initiated neutral, target price 425. Interglobe Aviation, the domestic demand has not peaked yet. That is what Motilal Oswal is saying. And where's Fusion Micro? That was an ET exclusive, where we're picking up that Warburg Pincus may sell 9.25% stake in Fusion Microfinance. So that's another stock, 6% higher as we speak right now. Ultratech too, because Citi is saying that this is their consensus top pick within the cement pack. So look out for what that stock as well does in trade. But good start to the trading day and expiry as well, or rather weekly expiry as well today. Kunal, what are the trades that you're punching a buy on?
Yeah, it's a good start for the indices. We are back above the 21,000 mark. In fact, we've scaled about 21,100 for the Nifty. I think what I also like is Bank Nifty nearing that 48,000 mark, which is again could be a good psychological breakout. Now, SBI is the stock which looks attractive, and I think that's a stock which I would look to trade in the open, especially given the fact that the stock is on the verge of a major breakout for itself.
Okay, Naresh, let's get in your first trade.
So it is SBI again. That's a stock which looks promising, just 5 rupees away from an all-time high. So a breakout which would last much longer. So a buy at current levels as well as on dips.
And I've seen rise, and I've seen gains, and I've seen linear moves. But when you see an IPO moving from 32 rupees of IPO pricing to 120 rupees in less than 6 weeks, I don't know what to say. Is it magic? Is it froth? Is it terrible underpricing by the merchant bankers? or is it only excitement of the market? IRDA, ladies and gentlemen, has gone from 32 rupees, right, Aisha? 32 rupees
32 is where it listed, yes.
32 is 123. It's a 4x. Krishna Kumar Karwa joins us. Let's take that conversation forward. I've seen multi-baggers. It's not that I've not seen multi-baggers, but I've never seen an IPO become a multi-bagger, and that to 4x in a matter of 14 trading sessions. What do you make of this market mood right now? I mean, is it only euphoria? Is it excitement? Or this is the realistic market where we should be enjoying the momentum rather than criticizing it?
Good morning, and thank you for inviting me to your show, Nikunj. Whether it's excitement, euphoria, the reality is that these are the prices. But having said that, I think some sectors where there is a lot of momentum, news flows, positive news flows, you will tend to see many of the stocks in that segment getting overvalued and maybe discounting 3-4 years forward earnings. And yes, you could possibly say that for some of the stocks that you were mentioning in the course of the conversation. So yeah, I mean, the market seems to be in a lot of tailwinds also, actually, honestly speaking, after the state election results and now what the US Fed has indicated as far as interest rate trajectory going forward. So these only add to the overall positive momentum which was always there, which is in terms of the domestic GDP growth, IIP numbers, robust inflows from domestic investors, and now hopefully going forward next year we should see very robust SBI inflows, and and that should lead the large caps which have relatively underperformed versus the small cap, mid caps in the last 1 year. I think a huge catch-up rally in the large caps is on the way.
Okay, I'd like to draw your attention to the big pivot by US Fed. Interest rates have peaked out and they will come down. Now that's a very powerful change for the market. 2021 and 22 and 23, we had to deal with rising interest rates. Now interest rates, they come down. What will happen because of that?
As I said, one is that the whole soft landing of the US economy, that kind of is given once the interest rates start correcting, and that should also obviously give an impetus for flows to move out again from the US to other emerging markets, and India could possibly be a prime beneficiary of that. Right. And more than that, I think also if you feel that the US economy is stabilizing or rather there's a soft landing, then the whole economic atmosphere over there, or rather all the IT companies, they should see the positive benefits out of it in terms of all the decision making which was kind of deferred at the end. I think all those things should make a comeback. So from that perspective, if I were to look at it, then good news flows for Indian companies because of the US economy stabilizing or achieving a soft landing and interest rates coming off. Plus valuation multiples. I think falling interest rates will always obviously lift the valuation multiples also.
Sure. So within large caps, given that you are betting on large caps catching up with what the broader markets have done so far this year, what's going to lead that catch up?
So obviously, I think it is the financials and possibly the IT companies. I think they should be the ones which should drive the large caps, and financials have relatively underperformed in the last 12 months, and now they have started catching up. So obviously, that's one segment which should possibly do very well. And IT companies, again, I think they had headwinds in the last 3, 4, 5 quarters, and the stock prices have also reflected that. Now, if they start getting positive news flow, I'm not saying it's going to happen overnight, but maybe in the next 2 quarters, you should possibly start seeing the positive impacts as the US corporates assess the economy and take forward their decision making. So that's one opportunity where in a rising market or in a robust euphoric market, valuations are relatively reasonable. Yes, growth is muted, but if growth makes a comeback, then that's where again investors would like to invest in. And yes, if SBI flows are going to be, they are going to more and more go into large caps. small mid caps cannot absorb those kind of flows also.
So I'm just spending a lot of time here, KK, with you because we are trying to understand that, okay, interest rates, they come down, growth stocks, they come back. What is growth? I mean, growth, let's say a couple of years ago, IT was growth. Then defense became growth. When we say that valuations come down and growth stocks go higher, what end of the growth cycle in India, specifically, if you can break it for our viewers, will benefit because of a rate cut cycle?
If you look at the the robustness of the Indian economy and the way your credit growth cycle is, so possibly a 15-20% kind of growth which is there for the credit for the banks and the NBFCs. I think that is the segment of growth that you should be looking at. If you look at consumer companies, FMCG companies, they are struggling. They are struggling at volume growth of 3-4% and below that. So growth for India basically means that the top line growth for for companies that you're looking to invest in has to be 15% plus. And that you can possibly see in auto companies, you can see in cap good companies, you could see in financials. I think those are the segments where you see that kind of robust growth on top line and accordingly your bottom line also grows equally well. So earning growth have to be plus 15% plus for investors to be interested in. So if you're asking me where is growth, or where investors will invest in, investors will obviously invest in these kind of companies where the bottom line at least 15-20% kind of growth and top line can be at least 15%. I think that is the growth segment that one is looking at, and anything below that is not par for the course.
KK,
I don't.
yeah.
Go ahead.
No, please. You want to finish that point?
No, I don't know whether I answered your question.
Yes. That's what we wanted to understand. Okay. Now let's understand the financials. Now, okay, financials are in a great spot. NPA cycles are low. Growth is decent, and there is no challenge whatsoever in terms of any NPA coming near term soon. But this is a template which markets are aware of. This is a sector where positioning is very high. So how does one know whether all the good news in banks is in the price or not?
A good question, Nikunj. I think if you see in the last 12 months, so wherever there was over ownership in the financials, I think those companies, despite the best of fundamentals, were unable to reflect that in the stock price performance. But having said that, some of the tier 2, tier 3 participants where there was relatively under ownership, those stocks have given phenomenal returns. I think the constraint was the FPI inflows were not so robust, and so you require huge amount of FPI inflows to be able to buy into these top tier banks. So if top tier banks, if you see positive FPI inflows, then top tier banks would again see that buying which is required. So there's nothing wrong in terms of what it's all about, over ownership, under ownership. Similarly, if you see of late, the domestic mutual funds also, the large cap focus mutual funds have also started seeing robust inflows, which will give them the headroom to be able to buy into some of these top tier banks where they are reasonably reasonably owned, but once more inflows are there, they should be able to buy into them more. So I think the maximum returns obviously will be made in the tier 2, tier 3 banks where under ownership is there, where valuations are still very cheap, and reasonable returns will be made in your top tier banks where you could possibly see incremental money being allocated.
Okay. KK, this entire excitement in PSUs, whether it is IRDA or whether it is PFC or REC, how would you rate the entire power ancillary, power financer, that entire space?
I think this is a multi-year theme, and we have just seen the beginning of it. And I think whether it's in the renewable space, a lot of investments are going to come in, whether it's solar, whether it's wind, etc. We have seen the Dubai announcements also in terms of how they transition from the fossil fuels. So it's a growth is given in this segment. There will be euphoria, right? But financiers, you cannot, and these are specialists who are trained to lend to this segment of the economy. So they will see robust growth in the coming years. I mean, and their ability to raise capital because of their ownership structure again is very strong. Valuations are still very, very reasonable for the growth that these companies can deliver. Dividend yields are still very reasonable. So yes, you are looking from a short-term perspective that the stocks have run up well, but still look at the valuations and look at the growth. My sense is that this segment of the market still has a lot of legroom and a lot of the rally, at least the financiers. Plus, obviously, all the component suppliers or all the full chain over there will benefit from this. Yes, some of the stocks in may be overpriced or maybe they're discounting 2-3 years in advance. But that's an opportunity. I mean, whenever the stocks correct, that could be an opportunity. But to ignore that segment would not be correct for portfolio investors.
Okay, KK, great to have you on the show. Thank you so much. And in case we don't meet again before the year ends, Happy New Year. See you in 2024.
Happy New Year to you and your team also. Thank you very much.
Okay, that's quite the contra call actually coming in, betting on IT, and that's where Krishna Kumar Karwa feels that you could see a big bump up ahead coming in from here. But let's just want to take stock of what the market as well is settled in at before we move forward, really. So while, yes, it's been an all-time record high for both the Sensex and the Nifty, let's just see what the composition is like. Because, yes, you've got the Nifty Bank holding out very well. Nifty Realty is looking very smart. But it's actually Nifty IT which is showing a bigger bump up than these names. Broader markets too looking good, yes. You've got an Emphasis, you've got a Coforge, you've got a Birlasoft, Persistent. These are all holding out just very smartly. Look at the move, in fact, on some of the frontline IT names. HCL Technologies is seeing a bump up of 3%. LTIM is up nearly 3%. TechM, Wipro, Infosys, TCS, they're all the top movers on the index right now. So seems like that IT trade is already playing out, at least sentimentally.
See, Asha, I think IT was also short. I mean, in this kind of a market where you know that market is headed higher, you don't want to have a large short, even though you may say that the sector is not like the best of the high growth sector, but you don't want to be short. And with global markets, the sentiment always is that global markets, when they do well, IT will automatically do well in terms of the connect effect with NASDAQ. So whether it is catch up, short covering, or perhaps the market way of, maybe some leadership, scuttle, I think IT in a sense today is going higher for technical factors, not so much so in terms of the fundamental factor. Shashank Srivastava joins us now, Senior Executive Officer with Maruti. Let's say hello to him. I can already see the jackets are out in Delhi. Is it really cold in Delhi, is it? Jackets are out.
Yeah, I think the minimum temperature 6.8 yesterday.
Oh my God.
Yeah, in the morning a little bit cold.
I'm coming in December and तो need to carry extra jacket. Muffler वगैरह भी लाऊं?
Yes, I think so.
Muffler वगैरह gloves तो की जरूरत नहीं पड़ेगी, right?
नहीं, gloves की जरूरत नहीं पड़ेगी. Yeah.
Okay, good.
But I think jacket will be on.
Good. Okay.
Yeah.
When we spoke to you last, you were reasonably confident that even post Diwali, the momentum will remain strong. Has that worked out as per what you indicated?
Yeah, so surely, if you look at December so far for Maruti, Suzuki in the industry also, the bookings are quite positive, about 12% up over last year. Inquiries are up about 22%. So it looks like the momentum continues. And the retail, I think, should be strong in December.
Most of the auto companies are considering a price hike, and price hike at a time when demand is also strong will straight away add to the bottom line. Can I assume the obvious that now we are in for margin expansion, better numbers, better growth, because everything is going right for the auto company per sector per se. Demand is strong, commodity prices are benign, and a price hike is being considered.
Yeah, so it really depends on the inflationary pressures, and you're right in terms of commodities. If they remain benign, then it's a different matter. But I think steel prices look like firming up a little bit, and therefore I think it really depends. The profitability will depend on what the cost structure emerges from here. 75 to 77% of the total cost actually for OEMs and auto is material cost. So obviously, commodity price movement will determine to a large extent the margin movement.
Shashank, our last interaction, what really stood out was the inventory levels that you were sitting at. Going into 2024, what is your sense on what kind of levels would you start the year with?
I think great question, because while I just mentioned the demand parameters being stable or actually positive in terms of inquiry and retail, on the stock side, I think the beginning of December stock was a little higher than what normally is for the December beginning. But remember, in December, industry tries to keep the stock levels down because of the model year change. So that's the reason why the wholesale numbers in the industry in December are generally very low. In fact, last year they were just 275,000, as against retail last year was about 411,000. So there was a huge difference between retail and wholesale, and that's a story which repeats every December, because industry and the channel partners would like to keep the stock down in the December end. And that's what is happening this year also, with the added sort of disadvantage. There is slightly higher levels of inventory as of 1st December. Therefore, it's very crucial in December to have very large retails, and that's what all the OEMs are trying to do. So, and you can also see the wholesale numbers this month will be lower in the industry. Current estimates are actually about 280 to 85,000.
So at your end, what is it that you're doing to resolve the high inventory situation?
Yeah, first of all, of course, we have limited our wholesales, which is a push to the dealers for adding to the inventory, and then we have rolled out a large sales promotion schemes, including some of the highest levels that you have seen in recent past, so that the inventory levels at the dealerships get cleared. In fact, you asked me a question about how much was the inventory level last year. The last year inventory levels was just around, in the industry, you will be surprised, about 50,000, 55,000. This year, even with the very high retails estimation and a lower wholesale estimation, inventory levels will be, to our current estimates, about 120, 125,000.
Are inventory levels pretty much same for sedan and for SUV also?
Yeah, generally, because we're at the remember the average retails in a month around 330, 340,000 for the industry. Current inventory around 340,000, 335,000. So that's like a 1 month stock. Then 120, 125,000 would actually be about 10, 12 days of stock. And that at that level of lower level of stock across the segments, it would be roughly similar.
Are we reaching that point in the SUV market where the market gain share of SUV is likely to peak out? Look, it's moved from 20% to 55%. But there would be a limit at which SUV as percentage of the total basket will peak out. Could that be 50? Could that be 60? Could that be 70? What is your understanding?
Yeah. So again, great question, because that's another thing which the industry is grappling. The rapid rise in the SUV segment, you rightly pointed out, 26% in 2019, come to about 53% last month, although April to November figures show it's about 48.9%. Pretty high. Generally speaking, our research shows that it should plateau around the 54% mark.
Market share has gone to 20% there broadly within the SUV market. Do you think do you have endeavor to maintain at 20, or you right now are looking at gaining more market share there? What would be your SUV strategy?
Yeah, so as I think in our last interaction, I did mention that in order to achieve our midterm objective of 50% share, we need to increase the share in SUV, and that's the reason why we have launched and strengthened our portfolio in the last year with the new Brezza, the Vitara, the Fronx, the Jimny, and that has enabled us to become the #1 SUV manufacturer in H1 of this year. Our market share currently around the 22.3% in the SUV sector. Hopefully, we will add a little bit more. Of course, the target with this 50% of the segments of the industry being the SUV segment if you do a back of the envelope calculation with a 65% share in the non-SUV, we need to get to about 35% in the SUV sector to get to 50% overall. So still we have a lot of ground to cover. We are happy currently with the 20 to 23%, but obviously we have to aim up to about 35% in the medium term in order to achieve the objective of 50% share.
I just want to understand as well a quick outlook from you as to what has been the response to Jimny, how it's done.
So Jimny, initially we had a very good. We had about 43,000 bookings first few months. It has done great numbers. Great numbers for that niche segment, that is. Last couple of months, actually, the retails have been less than what we had been expecting. So what had really happened was that the demand for the Jimny, about 50% automatic transmission, about 55% automatic transmission, and about 45% manual transmission. We had some constraints in supplying the automatic transmission. So we had necessarily to produce a larger number of manual transmission, for which the stock went up because, as I just mentioned, the retails in the last couple of months had not been good. And that's the reason why we have a very good sales promotion scheme this December, because we would like to reduce the stock, as I mentioned in the earlier part of our conversation, so that the carryover of FY23 stock into the calendar year 24 is to the minimum.
All right, Shashank, good to have you on board. Thanks so much for taking time out and joining in. So as of now, the UV market share could peak out at 54 to 55%. Bookings are positive. Steel prices are firming up. That's the stock price in focus at 10,342. Quick break. Be right back. Thanks for staying on with us. From one corporate voice to another, Mahindra Lifespace in the spotlight, and Amit Kumar Sinha is the MD and CEO now joining in. Thanks so much for taking time out. We want to understand your long-term growth prospects. So let's begin by talking about FY23. That was clearly a breakout year for the company, and you were gearing up for a 5x growth over the next 5 years. So does that mean that now you're expecting a strong upcycle in the real estate sectors to sustain at least for the next 5 years?
Yeah, thank you for having me. Absolutely, we are very bullish on the sector. Just to give you a reference point, we are roughly $250 billion market, real estate market in the country today. China, obviously going through its own challenges, is $2 trillion today. And as the population is similar, per capita income is growing, we expect this $250 billion market quadruple in the next 7 years. Obviously, there'll be kings, there'll be ups and downs, but we expect the organic growth to continue. And that gives us enough reasons to continue to bet on this sector.
So what exactly is driving this confidence? I want to understand from you as to what's working for Mahindra Life.
Yeah, so there are three factors that are going to be critical for us as we think about this journey from where we are today to 5. First is, as we talked about, the market is very healthy. But in the last decade, there's a huge shift from unorganized sector to organized sector. Brands like Mahindra are going to benefit from that. In the past, it used to be 90% unbranded or local builders used to participate in the real estate industry, 90%. Now that's down to 75%, 70%. It's different by cities. So the branded players, the listed players, are taking share away from unorganized sector or less organized sector. That's the biggest tailwind in our favor. The second part that we see is post-COVID, from a customer perspective, the consumer perspective, they want to upgrade from their existing home. They want to have the feeling of Dil Mange More, where they want to have a home which have workspace, sufficient space for families, sometimes nuclear, sometimes larger families. So that behavior is, I would say, organic and will continue to be there for Siemens region. And the third part is from Mahindra perspective, Mahindra Lifespaces has been designated as a growth gem. What that means is Mahindra Group is all behind. From a funding perspective, from a support perspective, talent perspective. So this is a business. If the industry is good, if the shift is happening for branded players, we are able to put the customers. Mahindra Group is going to put a lot of effort behind making sure that we get our fair share of the market. So these three things give us the confidence that we'll be able to take on the market context and get our fair share.
Sure. Amit, the second half is generally a stronger quarter for real estate companies. Throw some light on the demand trends on ground in terms of footfall conversions, how your recent, launches also performed, and what do you have in the pipeline going forward?
Yeah, no, great question, and we are really gearing up for our second half, or I think the next 4 months. Given Diwali, festive season, holidays tends to be a very exciting season. So what we had planned was 9 launches for current financial year. So far in the first 2 quarters, we have seen the impact of launches that we did in the previous financial year. It was more sustenance sales or launch of the new phases of the launches that we did in the previous year. But in the second half, especially in the quarter 4, we have a few new launches planned in Mumbai, in Pune, and Bengaluru, which are the focus geographies for us. These are projects that are going to be quite different from what we have done in the past. As you may know, we have done affordable and mid-premium. And we believe that Mahindra brand promise is linked towards premium projects, taking the inspiration from our auto business. So these 3 projects that we are launching, which are quite interesting, you'll see them in the news in the next few months. You'll see the shift towards premiumization that will attract the customers in line with how the market is shaping up, how the customers are looking for the value proposition, and what we can promise to deliver for customers. So that's what we're also trying innovative things from our side. We had our first ever metaverse-based launch in Pune at the end of October. What that means is you could actually see the exact unit, exact floor, how the balconies are, how the roofs are, and get a much better sense of your own apartment in a virtual, but a very realistic virtual. So those kind of, and this is first of a kind in the country, and we've been told that this may be the first in the world. So those kind of unique ways of getting customers excited about their dream homes is something that we are bringing to the market. That will make our launches even more exciting as they look at various choices they have at their disposal.
I also want to talk about some of the recent developments at the company because you continued your JV or rather joint development of land parcel in Dahisar. What was the rationale behind this decision? Any impact on your launch pipeline that it may have? And of course, the future business development plans too.
Yeah, so just a clarification, Dahisar is something that we got out of recently. It was announced almost 18 months back. There were some CPs, conditions precedent, that were required to be met, but they hadn't happened. So what we have done is we have announced our exit from that opportunity. We are very focused on making sure whatever land opportunity comes to us, we are taking a decision in a shortest and fastest time frame. So the one that we announced recently is in Pune, in Wagholi, which is a partnership with one of the landowners there. And that's something we are very excited about because we have been able to bring that project to market very soon. But broadly speaking, as the land prices have gone up, we always look for the right partnership. So while we have the opportunity to buy land outright, we also have multiple opportunities to do joint development with landowners. So it aligns with a win-win economic perspective. And we also forward into society redevelopment where we don't have to buy land, but we work with the society. And you'll see 2 more launches in the next 6 months. One in Malad Navy colony and one in Santa Cruz, which are part of our society redevelopment.
What would be the split, if you could tell us? How much of a project would be built, developed, where you will buy the land and you will just do it what could be called as complete turnkey development. How much of your total revenue projected will now or could come from the turnkey development, and how much could come from JV development?
Yeah, so great question. This differs by cities. I would say in Pune and Bengaluru, 80% of our development or GDV, as we call it, would be based on outright purchases, and 20% would be, let's say, partnerships. Whereas in Bombay, that ratio would be, let's say, 50% outright land purchases, and 50% and maybe more on the joint development as well as society.
Most of the debt company or real estate companies are saying that we will go easier on our debt. We spoke to the management of Lodha. They are looking at net gearing of less than 1. DLF technically is almost net debt free if I take the reserve out. What would be your plan? Because with Mahindra Group advantage, you have no problems in raising debt. When others are contracting, you can expand. So what is the strategy you're likely to follow?
Yeah, so I think we are very careful about the real estate cycle. And the most of the challenge that we've seen in the past, especially in the last decade, is where there was a huge exuberance about the market, and the balance sheet from that perspective was not healthy. So we're very careful about that. Our debt to equity ratio is very healthy. You can say that we're not taking advantage of debt, but we are a very conservative company, conservative group. So we want to abide by the principles. Our cost of debt is 300 basis points cheaper than some of our peers, given Mahindra Group heritage and how we have developed the company from a risk reward. So while we are open to taking debt for our growth, we are going to be very careful about it. Debt to equity ratio of anywhere from 30 to 40% would be acceptable. We are less than 10% today. We want to use that gap that exists in a healthy way and to support our growth aspiration, but that's not something we're going to over leverage for the right reasons.
New cities are you likely to add into your fold in next 12 months?
Can you repeat the question?
How many new cities are you likely to add in your portfolio next 12 months?
No, so we are actually being very careful about depth versus breadth. Our goal is to go deep in cities rather than go broad across multiple cities. So our primary focus from a residential point of view is going to be Mumbai, Pune, and Bengaluru. Just for reference, all the organized players combined have 20% market share in these cities, 20%. So it's very small. So there's a huge headroom for growth as we think about branded players taking share away from, let's say, less branded players. We'll focus on going for depth in these three cities. We have projects in a couple of other places. We'll evaluate them like NCR, Gurgaon, and other cities. We will evaluate them in the next 12 to 24 months, whether it makes sense for us to go for breadth if we are able to achieve our aspirational depth in these three primary cities.
Sure. Okay, great to have you on the show. Thank you so much for taking the time out and joining in today.
Thank you for having me. Pleasure.
Okay, on that note, we're going to take a very quick break, still holding on for the markets. When we come back, we'll talk about the primary market. We'll have the management from DOMS Industries join in on the other side. Okay, back with first trades right here in 80 now, and the first trades are holding out very steadily. 1% higher is where we're currently at, holding on to that life high. So 21,171 is where we're currently at for the Nifty. In fact, look at the futures. It's a tearaway run there too. 200 points higher. And by the way, we're already at 21,200 on the Nifty futures. And it's interesting to see that not just the large caps, but the broader markets as well are continuing to hold out. Look at the move on some of the broader market consistents. You've got a Manappuram, which is higher by 5.25% right now. Emphasis, which is scaling higher 5%. Coforge, Sale, Birlasoft. These are all names which are looking very, very smart indeed in trade.
All right, let's move right on then and focus in on DOMS Industries. Santosh Rasiklal as well as Rasha, the CFO of the company, both joining in on the show. Thank you so much for taking time out. Let's delve a little more then into the business and talk a little bit about what exactly the fundraise will be used for and how you're looking at growing the business, because there's been a stellar retail response.
Thank you very much for having us here today. So basically, post this last 3 years, I would like to take you through a little bit of what we have done. 2021 was the year when we was an affected COVID year. Still, we were able to do around 400 crore out of this year. Following to this, 2022, we were able to do around 680 crore from this year. And in 2023, we were able to grow at around 77%, reaching to 1211 crore revenue from year 2023. So basically, today we are operating into around 7 categories, and in the scholastic stationery, scholastic art, paper stationery, kits and combination packs, office supplies, hobby and craft, and fine art categories. And I would like to say that here all the categories have been very interesting and filled with all the opportunities. So we are here looking forward to complement all these categories and take all the advantages coming out of all these opportunities from these existing categories. Plus one, we have a target of writing instruments as a new entry to the new product, where we are looking forward to invest around 450 crores, and out of which we are going to raise around 350 crore through fresh issues, where 280 crore will be utilized for expansion of and production of this writing instrument manufacturing facilities, and the 70 crore from this fresh issues will go for our GCP.
Sure. I also wanted to understand, your EBITDA margins as per the first half in your RHP, they were around 17%, which is higher than most of your domestic peers. And, any one of you could actually come in on that. Give me a margin profile for both pencils as well as the mathematical instruments, and what is the outlook that one can see going forward? The range, if you could just give us that.
So basically, as I said, we are operational through around 7 different categories, and as a very disciplined company, we have always been focusing on working on our operating margins. Moreover, so across our categories, we are operating through a very balanced operating margins. Yes, I would like to confirm that we have been able to grow a little. From 15.4% in 2023 to our H1 of at 16.7%. But this is coming more from the operational efficiencies point of view, and also a very little from probably I can say there is an advantage currently where the raw material prices are at most low, and this is the advantage we have been able to get in H1. Still, I would like to say a reference of 2023 is a good reference. We would like to balance.
Very simple question in terms of the factor of China. Most of the stationery companies in the past have struggled because of cheap manufacturing units which have been set up in China. Isn't that a binary risk? What if China comes back? What if trade negotiations they start again? What happens in that case?
So what today we are really, as an industry, we are really confident on is that our efficiencies across these years we have been able to create are much more dynamic. Today we are, I can say that with a lot of research and development in place, the offerings what we have from our company is much more beyond the expectations of our consumers today. And of course, we all have observed that there is a too much of shift, from our Indian consumers from unbranded things to branded products. So this is, I'm sure that this is really helping our industry, and we really don't fear right now with any of this threats coming from any peer countries.
Rahul, where is the organized versus unorganized market number, Rahul, according to you in this industry? You know, because there is this nukkad wala in every mohalla. I have fond memories of going to that nukkad wala dukan and getting my pens and pencils. That uncle had 3 varieties, 2 branded, 3 non-branded. What is happening there?
So if you look at the overall stationery industry, it is pegged at around 38,500 crores in terms of market value. Largest part coming from paper stationery. In terms of branded to unbranded, it is about, branded would be about 38% right now. But if you look at, going forward, branded stationery is likely to increase its share upwards of 50%. So this entire shift that is happening from unbranded to branded, plus quality consciousness coming in, plus a lot of importance given by the government to primary education. This is boding well for the industry. We believe that branded stationery, especially in the segment that we are present in, is going to do really well.
What, to your mind, are the base margins in this industry, Rahul? I mean, base margins, 1 or 2% here or there could be a function of raw material, new product launches, distribution launches. For DOMS, what do you think are the base margins irrespective of the volatility?
So for us, margins across our product categories are something very similar. We work on a mantra that we call, nothing at the cost of margins, nothing at the cost of market. Whenever we feel there are increase in certain prices or certain direct costs, today the brand is strong enough to, allow it to pass on to either our consumers or through the supply chain. And so we work on that philosophy, and that's why we said, the margins of about 15.5% to 16% that we did during FY23 is something which we'll be comfortable achieving at.
Both of you, thank you so much for taking the time out, Santosh and Rahul, and helping us understand the purpose of the IPO and how business has been off late. Let's move on, and let's also talk about what really is happening with Dhanuka Agritech. And we have Mr. M.K. Dhanuka, the MD, joining in on the show right now. Mr. Dhanuka, great to have you today on ET Now. From what we understand, Rabi sowing has been poor. The sowing area is down about 5% on a year-on-year basis. Tell me, what is your own growth outlook for the second half of the fiscal, considering you've had a good run in the first half despite challenges?
You are absolutely right that the sowing is 5% less during this Rabi season because of the rainfall not adequate. But overall, the situation is not very good, I can say, because season is not moving the way the industry was expecting. And during the second quarter, we are expecting single-digit growth only because of this season not favorable. And overall, revenue-wise growth will not be there, but profitability will be better. We expect 150 bips improvement in gross margin and 100 bips improvement in EBITDA margin minimum.
Do you think this entire seasonality of monsoon is something which can be called as temporary only then?
Pardon? Please repeat the question.
So the seasonality of monsoon, can I say it is only a one-quarter phenomenon?
Yeah, usually it's a one-quarter phenomenon, but overall, the whole year the monsoon should remain good because still we have only 40% irrigated area and 60% is still dependent on rain god. So rain is really very, very important for the growth of the agriculture and the agrochemical industry. So rainfall plays a very important role, and if rainfall is good during the remaining period of the year, only then the industry can do well.
To understand how the raw material prices have moved, base raw material prices, because you are importing and then you are in a sense, assembling is not the right word, but then you're creating your own pesticides by, by chemical synthesis. What is happening to the base prices?
We are having around 50% portfolio of specialty molecules from Japan and other US countries, etc. There is no basically change in the prices. The prices are stable for those molecules. But definitely in generics, the price are reducing month on month basis. Every month we presume that now bottom has come, but again the price comes down. So that tendency is still going because of the much higher capacities built in China. The government of China asked the industry to shift to the other areas where they made double capacities. So availability of material is much more in comparison to demand, and that's why the prices are reducing month on month basis, and that trend is still continued. And I hope that till March this will not stop, but definitely next Kharif season we expect that the prices should start increasing.
Is the per capita insecticide consumption or your product consumption moving? What I'm trying to understand from you is that as upgrades are happening, is the per capita consumption per farmer or per acreage also changing for you?
Yeah, value-wise, definitely it is changing because the new molecules, new technology which is coming, they are eco-friendly, less toxic, safer for the environment. But however, that new technology is costly also. But it gives the solution to the farmer for its problem. So farmers are ready to adopt the new technology, and they are using the new products which are introduced by the various companies in India. So that's why overall value-wise the consumption is increasing, but volume-wise, because the doses are less for the new molecules, the volume-wise, the quantity-wise, volumes are coming down.
Mr. Nanaka, help us understand what really is happening at this new Dahej plant that you've set up. What's the commissioning right now? What is the capacity that you hope to take it to in the next phase, etc.?
You see, presently we have put up only one plant over there where we are manufacturing bifenthrin technical, and in the this year we expect to manufacture around 250 metric tons of bifenthrin technical. Shortly, we are going to start the lambda cyhalothrin technical also over there. But actually, we are waiting for some Japanese tie-up for manufacturing of contract manufacturing for any product. So the real basically benefit for the Dahej plant will start coming once we have tie-up with Japanese company. Initially with the generic products, basically profitability will not come because there is tough competition and generic prices are all-time low at present. So we don't expect any profitability from Dahej plant at initial stage.
Why are global pesticide and agrochemical companies giving profit warnings? BASF, Bayer. You're talking about growth, but globally these companies are giving profit warnings. Is there something happening at global level we need to be aware of?
You see, these companies are introducing new molecules which are researched by them. So there they don't have any competition, and they charge high premium for the new molecules. That's why their profitabilities are higher because they spend much more for the invention of the molecule. As per information, around 2000 crore rupees are spent, and it takes 10 to 15 years time for invention of a new molecule. So that these German and USA and Japanese companies are doing, and they are definitely making better profit margins in comparison to the brand sales players.
So 2025, how much of your current portfolio will be commodity and how much would be specialty?
It will be 50-50 more or less, 2-3% here and there.
And are there any new molecule launches in next 12 months which you are excited about?
Yeah, definitely. There are a lot of new molecules in the pipeline, and we hope that first time we will be launching 3 to 4 9(3) molecules in FY 24-25, and we are bullish about one of the molecule which we hope that it's insecticides from Nissan Chemical Japan, and we hope that that product will perform very well in the market.
Suffice to say, Mr. Dhanuka, that you will perhaps up your FY24 guidance, or would it be at the last quarter margin level of 23 odd %?
No, it will be better. Margins will be much better in FY25 because one, we are going to introduce some new molecules, and secondly, it depends on the monsoon. If monsoon is good, then definitely we will be doing double-digit growth in top line and improvement in the EBITDA margins.
Dhanuka, great to have you on the show today. Thank you so much for taking the time out. We'll take a very quick break on that. When we come back, address more markets and corporates.